Section 2.1 to 2.3 Dollar cost averaging. 2.1 Selecting the investment. Dollar cost averaging can be applied to a wide range of assets and investment vehicles. The suitability of a particular asset or investment vehicle for dollar cost averaging depends on several factors, including your investment goals, risk tolerance, and the availability of investment options. Here are some common assets and investment vehicles that are often used for dollar cost averaging. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They offer a variety of investment objectives and asset classes, making them suitable for dollar cost averaging. Regularly investing a fixed amount in a mutual fund allows you to gradually accumulate shares over time. Exchange-traded funds, ETFs. ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. They offer exposure to various markets, sectors, or asset classes. ETFs can be a suitable choice for dollar cost averaging, as they provide diversification and are available for a wide range of investment strategies. Index funds. Index funds are designed to track a specific market index, such as the S&P 500. They offer broad market exposure and typically have lower expense ratios compared to actively managed funds. Dollar cost averaging into index funds allows you to invest in the overall market and benefit from its long-term growth. Stocks. Investing in individual stocks can also be suitable for dollar cost averaging, especially if you have a long-term investment horizon and a well-researched selection of stocks. Regularly purchasing shares of selected companies allows you to build a portfolio over time. Bonds. Bonds provide fixed income and are considered relatively less volatile compared to stocks. Dollar cost averaging into bond funds or individual bonds can help you accumulate a diversified fixed income portfolio gradually. Exchange-traded notes, ETNs. ETNs are debt instruments that provide exposure to the performance of an underlying index or asset class. They can be used for dollar cost averaging, similar to ETFs. By investing a fixed amount at regular intervals, real estate investment trusts, REITs allow you to invest in real estate without directly owning property. REITs often distribute dividends and can provide long-term growth potential. Investing in REITs through dollar cost averaging can help build a real estate portfolio over time. Precious metals. Precious metals like gold and silver are often considered as a hedge against inflation and economic uncertainty. Investing in precious metal ETFs or funds through dollar cost averaging can be an option for long-term investors seeking exposure to these assets, when selecting suitable assets or investment vehicles for dollar cost averaging. Consider factors such as diversification, liquidity, expense ratios, historical performance, and alignment with your investment goals. It's advisable to research and consult with a financial advisor to identify the most appropriate options based on your individual circumstances and risk tolerance. Evaluating factors such as risk tolerance, investment horizon, and diversification is crucial when making investment decisions. Here's a breakdown of each factor and its importance in the evaluation process. Risk tolerance. Risk tolerance refers to your ability to withstand fluctuations in the value of your investments and your willingness to take on investment risk. It is influenced by factors such as your financial situation, investment goals, time horizon, and personal comfort level with risk. Conservative risk tolerance. If you have a conservative risk tolerance, you may prefer lower risk investments such as bonds or fixed income assets. Dollar cost averaging into conservative investments can help manage risk and provide stability to your portfolio. Moderate risk tolerance. If you have a moderate risk tolerance, you may opt for a balanced portfolio that includes a mix of stocks, bonds, and other asset classes. Dollar cost averaging into a diversified portfolio can help moderate risk and potentially provide a balance between growth and stability. Aggressive risk tolerance. If you have an aggressive risk tolerance and a long investment horizon, you may be more willing to invest in higher risk assets such as stocks or equity funds. Dollar cost averaging into more aggressive investments can allow you to capture potential higher returns over the long term. Investment horizon. Your investment horizon is the length of time you plan to invest before needing the funds. It plays a crucial role in determining the suitable investment options and strategies. Short-term investment horizon. If your investment horizon is short-term, typically less than 3 years, you may prioritize investments with lower volatility and greater liquidity, such as cash or short-term bonds. Dollar cost averaging into conservative investments can help preserve capital and provide stability. Long-term investment horizon. If your investment horizon is long-term, 5 years or more, you may have the opportunity to tolerate more volatility and pursue higher potential returns. Dollar cost averaging into a diversified portfolio with a mix of asset classes can help capture market growth over the long term. Diversification. Diversification is the practice of spreading your investments across different asset classes, sectors, and geographic regions to reduce risk. It is essential for managing risk and potentially enhancing returns. Asset class diversification. Diversifying across asset classes, such as stocks, bonds, and cash, can help balance risk and return. Dollar cost averaging into a diversified portfolio can ensure exposure to multiple asset classes and reduce the impact of a single asset's performance on your overall portfolio. Sector diversification. Within each asset class, diversifying across sectors, example, technology, healthcare, energy, can further mitigate risk. Dollar cost averaging into different sectors can provide exposure to a broad range of industries and reduce concentration risk. Geographic diversification. Investing in different geographic regions can help reduce the impact of regional economic or political factors on your investments. Dollar cost averaging into international funds or global ETFs can provide geographic diversification. It's important to note that risk tolerance, investment horizon, and diversification are interconnected factors. Your risk tolerance influences the investment options you choose. Your investment horizon determines your time frame for potential returns, and diversification helps manage risk across your investment portfolio. When evaluating these factors, consider your personal circumstances, financial goals, and the level of involvement you want in managing your investments. It's advisable to seek professional advice from a financial advisor who can help assess your risk tolerance, investment horizon, and diversification needs and provide personalized recommendations aligned with your objectives. When considering investment options such as index funds, ETFs, or individual stocks, it's important to assess various factors to determine which option aligns best with your investment goals. Risk tolerance and preferences. Here's a breakdown of these investment options. Index funds. Definition. Index funds are mutual funds or exchange-traded funds, ETFs, that aim to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. They hold a diversified portfolio of securities that mirrors the index's composition. Advantages. Diversification. Index funds provide instant diversification across a broad market segment or asset class, reducing the risk associated with individual stocks. Low costs. Index funds typically have lower expense ratios compared to actively managed funds, as they aim to passively track an index rather than relying on active management. Consistent performance. Index funds often offer consistent performance relative to their benchmark index, making them suitable for long-term, low-maintenance investing. Considerations. Limited flexibility. Index funds replicate the composition of the underlying index, so you have limited control over the specific securities in the fund. Lack of active management. Index funds do not employ active strategies to outperform the market, so they may not capture the potential upside of individual stock selection or market timing. Exchange-traded funds, ETFs. Definition. ETFs are investment funds that trade on stock exchanges, similar to individual stocks. They hold a portfolio of securities, such as stocks, bonds, or commodities, and offer investors exposure to various market segments or asset classes. Advantages. Diversification. Like index funds, ETFs provide instant diversification across a specific market segment or asset class, reducing the risk associated with individual securities. Liquidity and flexibility. ETFs can be bought and sold throughout the trading day, offering liquidity and the ability to react quickly to market movements. Lower costs. ETFs generally have lower expense ratios compared to actively managed mutual funds. Considerations. Trading costs. Buying and selling ETFs may involve transaction costs, such as brokerage commissions, which can impact overall returns if you frequently trade. Premiums/discounts. ETF prices can deviate from the net asset value, NAV, of the underlying securities, resulting in premiums or discounts to their intrinsic value. Individual stocks. Definition. Investing in individual stocks involves purchasing shares of specific companies listed on stock exchanges. Advantages. Potential for higher returns. Selecting individual stocks offers the potential for significant gains if you make well-informed investment decisions, flexibility, and control. Investing in individual stocks allows you to have direct ownership in specific companies, providing the opportunity to align your investments with your values or investment strategies. Considerations. Higher risk. Investing in individual stocks carries higher risk compared to index funds or ETFs since the performance of your investment is dependent on the success of specific companies, research and monitoring. Investing in individual stocks requires substantial research and ongoing monitoring to make informed investment decisions and stay updated on company news and performance. When choosing between index funds, ETFs, or individual stocks, consider your risk tolerance, investment goals, time commitment for research and monitoring, and preferences for diversification and control over your investments. Some investors may opt for a combination of these options to strike a balance between diversification and the potential for individual stock selection. It's advisable to consult with a financial advisor who can help assess your specific needs and provide personalized recommendations based on your circumstances. 2.2 Determining the investment amount and frequency. Establishing an investment budget and determining the amount to invest regularly involves considering your financial situation, goals, and risk tolerance. Here's a step-by-step approach to help you determine the appropriate investment budget and regular investment amount. Assess your financial situation, evaluate your income, expenses, and overall financial health. Understand your cash flow and determine how much money you can comfortably allocate towards investments without affecting your essential living expenses and emergency fund. Set clear investment goals. Define your investment goals and time horizon. Are you investing for retirement, education, a down payment on a house, or another specific objective? Understanding your goals will help determine the investment strategy and time frame. Evaluate your risk tolerance. Assess your risk tolerance and comfort level with market fluctuations. Consider your ability to handle potential investment losses and your investment horizon. A longer investment horizon may allow for a higher risk tolerance. Determine the investment period. Decide on the frequency of your investments. Will you invest monthly, quarterly, or annually? Setting a regular investment schedule allows for consistent contributions over time. Calculate an affordable investment amount. Calculate an amount that you can comfortably invest regularly without jeopardizing your financial stability. Consider your income, expenses, and savings rate. It's generally advisable to save and invest a percentage of your income, such as 10% to 20%. Consider dollar cost averaging. Dollar cost averaging involves investing a fixed amount at regular intervals, regardless of market conditions. It can be a suitable strategy to mitigate the impact of market volatility and help build a disciplined investment approach. Determine the regular investment amount based on your budget and commitment to dollar cost averaging. Review and adjust periodically. Regularly review your financial situation and adjust your investment budget and regular investment amount as needed. As your income, expenses, and goals change, you may need to revisit your investment strategy and make necessary adjustments. Seek professional advice. Consider consulting with a financial advisor who can provide personalized guidance based on your specific financial circumstances, goals, and risk tolerance. They can help you determine an appropriate investment budget and regular investment amount aligned with your objectives. Remember, it's important to strike a balance between investing for the future and maintaining financial stability in the present. Start with an investment budget and regular investment amount that you can comfortably afford, and gradually increase it as your financial situation improves. Regularly review your progress, stay disciplined, and adjust your investment strategy as necessary to stay on track towards your goals. Deciding on the frequency of investments, whether it's monthly, quarterly, or another interval, depends on various factors including your investment goals, cash flow, and personal preferences. Here are some considerations to help you determine the most suitable frequency for your investments. Investment goals and time horizon. Consider the time horizon of your investment goals. If your goals have a longer time horizon, such as retirement planning, investing on a monthly or quarterly basis may be more appropriate as it allows for consistent contributions over time. For shorter-term goals, a higher frequency of investments might be desirable to take advantage of shorter-term market opportunities. Cash flow and budgeting. Assess your cash flow and budgeting. Determine how much money you can allocate towards investments on a regular basis without jeopardizing your essential living expenses, emergency fund, and other financial obligations. It's crucial to maintain a balanced approach that considers both investing and maintaining your financial stability. Cost efficiency. Consider the cost efficiency of your investment strategy. Some investment platforms or brokerage accounts may charge transaction fees for each investment made. If the fees are a significant factor, you might prefer less frequent investments, such as quarterly, to minimize costs. Diversification. Diversification is an essential aspect of investment strategy. Investing at regular intervals allows you to spread your investments across different market conditions. For example, by investing monthly, you can potentially benefit from buying at different price points, reducing the impact of short-term market volatility. Behavioral considerations. Reflect on your personal discipline and behavior as an investor. Regular investments can instill discipline and help you avoid emotional decision-making based on short-term market fluctuations. It can be easier to maintain consistency in your investment approach when you have a set schedule for contributions. Convenience and administration. Consider the convenience and administrative aspects of managing your investments. Different investment platforms and accounts may have varying processes for making regular contributions. Choose a frequency that aligns with your comfort level and administrative capabilities. Ultimately, there is no one-size-fits-all answer to the frequency of investments. It's essential to evaluate your specific circumstances, financial goals, and preferences when determining the most suitable frequency for your investments. You may also consider consulting with a financial advisor who can provide personalized guidance based on your unique situation. Aligning the investment amount and frequency with your personal financial circumstances is crucial for maintaining a sustainable investment strategy. Here are some considerations to help you determine the appropriate investment amount and frequency. Assess your financial situation. Start by evaluating your overall financial situation, including your income, expenses, debts, and savings. Understand your cash flow and determine how much money you can comfortably allocate towards investments without compromising your essential living expenses and financial obligations. Budgeting. Create a comprehensive budget that outlines your income, fixed expenses, example rent/mortgage, utilities, insurance, variable expenses, example groceries, entertainment, and savings goals. From your budget, identify the portion of your income that can be allocated towards investments. It's important to strike a balance between investing and maintaining a healthy financial foundation. Emergency fund. Before committing to regular investments, ensure you have established an adequate emergency fund. An emergency fund should typically cover 3 to 6 months' worth of living expenses. It provides a financial safety net and protects your investments from the need for premature liquidation in case of unexpected events. Investment goals. Clarify your investment goals and time horizon. Determine if you are investing for short-term objectives, example down payment on a house, vacation, or long-term goals, example retirement. Your investment goals and time horizon will influence the amount you need to save and the frequency of your investments. Risk tolerance. Consider your risk tolerance and comfort level with market fluctuations. If you have a lower risk tolerance, you might prefer to invest smaller amounts more frequently to mitigate the impact of market volatility. If you have a higher risk tolerance, you may opt for larger investments at less frequent intervals. Regular cash flow. Evaluate your regular cash flow and income patterns. Determine if you have a consistent income source or if your income fluctuates, example, self-employment, commission-based. If your income is irregular, you may need to adjust the investment amount and frequency accordingly. Automation. Consider automating your investments by setting up automatic transfers from your bank account to your investment account. Automating your investments helps ensure consistency and removes the need for manual contributions, making it easier to stick to your investment plan. Periodic review. Regularly review your financial situation and make adjustments as needed. Changes in your income, expenses, or financial goals may require you to reevaluate your investment amount and frequency. Periodic reviews also provide an opportunity to assess your progress towards your goals and make any necessary modifications to your investment strategy. Remember, personal financial circumstances are unique, and what works for one person may not work for another. It's important to evaluate your own situation, seek professional advice if needed. And establish an investment plan that aligns with your financial circumstances, goals, and risk tolerance. 2.3 Automation and systematic investing. Leveraging automation tools and platforms can be an effective way to facilitate dollar-cost averaging and make the process more convenient and streamlined. Here are some automation tools and platforms you can consider. Automatic investment plans. Many brokerage firms and investment platforms offer automatic investment plans that allow you to set up recurring investments at predetermined intervals. You can specify the investment amount and frequency, and the platform will automatically execute the trades on your behalf. This feature ensures consistent contributions to your investments without the need for manual intervention. Direct deposit allocation. If you receive your income through direct deposit, you can allocate a portion of your paycheck directly to your investment account. This allows you to automate your investments by having a portion of your earnings transferred to your investment account before you even have a chance to spend it. Robo-advisors. Robo-advisors are online platforms that use algorithms to provide automated investment advisory services. These platforms often offer dollar-cost averaging as a core feature. They assess your risk tolerance and investment goals and create a diversified portfolio of low-cost ETFs. They then automatically invest your funds and rebalance the portfolio periodically to maintain the desired asset allocation. Mobile apps. Many investment platforms offer mobile apps that allow you to manage your investments on the go. These apps often have features that enable you to set up recurring investments, track your portfolio performance, and receive notifications about account activity. With mobile apps, you can easily monitor and adjust your dollar-cost averaging strategy from your smartphone or tablet. Online banking tools. Some online banking platforms offer features that allow you to automate transfers from your bank account to your investment account. You can set up recurring transfers at regular intervals, aligning with your dollar-cost averaging strategy. These tools provide convenience and help ensure consistent investments without the need for manual transfers. Calendar alerts or reminders. If you prefer a more manual approach, you can set up calendar alerts or reminders to prompt you to make your regular investment contributions. This can help keep you disciplined and ensure you don't miss any investment dates. When leveraging automation tools and platforms, it's important to choose reputable providers that align with your investment goals and preferences. Consider factors such as fees, investment options, ease of use, customer support, and security when selecting the platform that best suits your needs. Remember, while automation can make investing more convenient, it's still important to regularly review your investment strategy, monitor your portfolio, and make adjustments as needed. Automated tools should be seen as a facilitator to support your investment plan, but you should remain actively engaged in managing your investments and staying informed about market trends and developments. Setting up automatic transfers or contributions to your investment accounts is a convenient and effective way to ensure consistent investments and facilitate your investment strategy. Here's a step-by-step guide on how to set up automatic transfers. Choose an investment account. Determine which investment account you want to contribute to automatically. This could be a brokerage account, a retirement account, such as an IRA or 401k, or any other type of investment account that allows automated contributions. Contact your financial institution or investment provider. Reach out to your financial institution or investment provider that manages the account you want to contribute to. They will guide you through the process of setting up automatic transfers. Complete necessary forms. The financial institution or investment provider will provide you with the necessary forms or instructions to set up automatic transfers. This may involve filling out an authorization form or providing instructions through an online banking or investment platform. Specify the transfer details. Provide the specific details for the automatic transfers, including the transfer frequency, example monthly, quarterly, the transfer amount, and the start date. You may also have the option to specify an end date or ongoing transfers until further notice. Link bank accounts. If the investment account is held with a different institution than your bank account, you will likely need to link the two accounts. This typically involves providing the routing number and account number of your bank account to set up the transfer. Set up automatic transfers. Once you have completed the necessary forms and provided the transfer details, the financial institution or investment provider will process your request and set up the automatic transfers. They will typically confirm the setup with you and provide instructions on how to make any changes or adjustments in the future. Monitor and review. regularly monitor your investment account and review the contributions to ensure they are executed correctly. If you need to make any changes, such as modifying the transfer amount or frequency, contact the financial institution or investment provider to update your instructions. Remember to consider your financial circumstances, budget, and investment goals when determining the amount and frequency of the automatic transfers. Regularly review your investment strategy to ensure it aligns with your goals and make any necessary adjustments as your financial situation or objectives change. Automating your investment contributions helps maintain consistency and discipline in your investing approach. However, it's still important to stay engaged with your investments, regularly review your portfolio, and make informed decisions based on your financial goals and market conditions. Monitoring and adjusting your investment amounts based on your financial goals and market conditions is an essential part of maintaining a successful investment strategy. Here are some steps to effectively monitor and adjust your investment amounts. Define your financial goals. Clearly define your short-term and long-term financial goals. This could include objectives like saving for retirement, purchasing a home, funding education, or achieving a specific financial milestone. Understanding your goals will help you evaluate if your current investment amounts align with your desired outcomes. Regularly review your portfolio. Periodically review your investment portfolio to assess its performance and progress towards your goals. Analyze the returns, risk profile, and diversification of your investments. Consider how market conditions and economic factors may impact your portfolio. This review process will help you identify if adjustments are necessary. Assess your financial situation. Evaluate your financial situation and any changes that may affect your investment strategy. Consider factors such as income, expenses, debt obligations, and changes in your personal circumstances. Understanding your financial standing will help you determine if you can increase or decrease your investment amounts. Revisit your risk tolerance. Assess your risk tolerance periodically. Your risk tolerance may change over time due to various factors, such as changes in financial obligations, market experiences, or a shift in your personal preferences. Re-evaluating your risk tolerance will help you determine if you need to adjust your investment amounts accordingly. Stay informed about market conditions. Stay updated on market trends, economic indicators, and industry-specific news that may impact your investments. This will help you make informed decisions regarding your investment amounts. Consider seeking information from reliable sources, financial advisors, or investment professionals to guide your decision-making process. Consult with a financial advisor. If you're uncertain about adjusting your investment amounts, consider consulting with a financial advisor. A professional advisor can provide personalized guidance based on your specific financial goals, risk tolerance, and market conditions. They can help you analyze your portfolio, recommend adjustments, and create a comprehensive investment plan. Make adjustments gradually. If you decide to adjust your investment amounts, consider doing so gradually rather than making abrupt changes. Gradual adjustments allow you to monitor the impact of the changes and make further adjustments as needed. Sudden and drastic changes may expose you to unnecessary risks or miss out on potential opportunities. Regularly reassess and revise. Review and revise your investment amounts periodically. Market conditions, financial goals, and personal circumstances can change over time. By regularly reassessing your investment amounts, you can ensure they remain aligned with your objectives and provide the potential for optimal returns. Remember that adjusting investment amounts is not a one-time decision but an ongoing process. It requires consistent monitoring, evaluation, and adjustment to optimize your investment strategy. Regularly revisit your financial goals, assess your risk tolerance, and stay informed about market trends to make informed decisions about your investment amounts.